Welcome to Smart Talk, where we speak with leading academics and other thoughtful persons on the important challenges facing the world today. My name is Edward Dodson. I am a longtime member of the faculty of the Henry George School of Social Science. Today, we have the pleasure again of speaking with Dr. Jack Rasmus on the very real problem of attaching meaning to the statistics compiled and issued by agencies of the federal government, as well as the Federal Reserve. Dr. Rasmus teaches economics at St. Mary's College in California and is the author of many books, most recently, The Scourge of Neoliberalism, U.S. Economic Policy from Reagan to Trump, published in 2019. He hosts a weekly radio program, Alternative Visions, on the Progressive Radio Network and regularly contributes articles on economic, political, and labor issues to various magazines. Jack, welcome back to the Henry George School Smart Talk program.
My pleasure.
Well, your recent communication questioning the accuracy and usefulness of all these government statistics on the economy is troubling. Already, a lot of us wonder whether reasoned policy decisions are really possible when actual conditions are either misunderstood or misrepresented. So my first question to you is, what do you think is the cause of this disconnect?
Well, you got to understand statistics are really manipulations on the raw data. You know, what gets reported in all these reports, whether it's Commerce Department, GDP, or Labor Department, CPI and jobs and whatever, the raw data, the actual numbers of jobs and inflation is really manipulated. And I don't mean in a negative way necessarily, but a statistic is a manipulation of real raw data. Okay, that's the first thing to remember. The second thing is it's not that these statistics by the government are purposely falsified. I mean, that's not the case. What you've got is different statistics. Sometimes they contradict each other. Sometimes they appear totally different because there's different assumptions underlying them when they do the manipulation, or there's a different methodology used, or the methodology is the best possible, but it's not very good. There's all these reasons why you come up with very contradictory information. For example, just one example here, the job numbers. The latest job numbers, one of the surveys show 353,000 jobs created in January, right? Another one showed, another Labor Department survey showed a decline in jobs in January. The first shows a unemployment rate of 3.7%. You look at another table, another survey that released at the same time by the Labor Department, right? And you get an 8% unemployment rate. So which one? Well, policymakers, government people, they like to pick the one that makes them look better, right? So they say, oh, unemployment is only 3.7. They don't say 8%, even though it's right there in the same report, right? The 3.7%, by the way, is only for full-time workers who looked for a job in the last 4 weeks. There's a labor force of 167 million. There's only about 120 million who are full-time workers. So you're leaving out 46 million part-time, temp, gig workers, independent contractors, and whatever. And when you throw those in, it's 8%. So, pick your poison, cherry pick what you want. And politicians do that. And of course, the media tends to follow suit. For obvious reasons, the business media, they don't want to pick the worst number because that influences perceptions by consumers and workers and businesses and so forth. So they pick the best number. So that's really what you got to understand from the beginning here, that it's not falsification per se. It's the fact that there's different assumptions, different methodologies, and different ways of coming up with numbers that differ.
And there's not enough time in the 6 o'clock news hour to get into the meaning behind those statistics. They just
right. But you gotta admit that they do cherry pick, right? They
Yeah.
cherry pick. The media cherry picks to make it look better or the best possible case here, rather than looking at the range and the possibility that other statistics may be better. You know, like that 3.7%, that 353,000, that comes from bigger businesses providing information to the labor department on their hiring. There's about 400,000 large businesses. Not all of them participate in sending the government the data, by the way. There's been a big drop off in the participation, which undermines that survey to some extent. But the other survey on jobs, called the population survey or household survey, is actually a survey where the government goes out and does phone and contacts and looks at prices and so forth. That reflects smaller businesses. So you may have the reality that bigger businesses are doing okay in hiring, but smaller businesses are laying off. Right. So, you know, the truth is in the details, and you got to peel the onion to get to the truth. But the media doesn't want to do that, and neither do the politicians.
Yeah, there's a lot of definition. I recall the difference in the workforce based on the starting age you choose and the ending age you choose. So are young people under age 25 part of that workforce? What about everyone over 18? It would have a major difference in the numbers. And I'm guessing now that if you look at who's part-time employed, it's going to be that 18 to 25 group is going to have a large portion of those individuals part-time employed.
Yeah, actually, the start age is 16.
16.
16 to 24. They do segment by age. They segment by ethnic background. They segment by veterans and non-veterans, by gender and so forth. So you can see where the problem might be for rising unemployment or rising employment. But when you look at the general number, no one really goes in unless they want to make a point about some legislation for veterans or something, segments it out.
Well, as often said, if your neighbor's unemployed, it's a recession. If you're unemployed, it's a depression. And I wonder, from the statistics that you've looked at, what do you think the trend is really? Are we moving closer to a higher level of unemployment that is going to grow, or do you think the fundamentals that are being employed by the Federal Reserve and the federal government, are they the right efforts to find the right balance between rising inflation and rising unemployment?
Yeah, well, in December 2022, Chairman of the Fed, Jerome Powell, right? He said, inaccurately, I believe, that goods prices are coming down, right? Goods meaning things that you buy that you either consume them right away, things, right? Like gasoline and food you consume. Those are called non-durables. You buy a car, that's a durable, right? Because a lot of the inflation had to do with energy prices. And also, I would add, certain companies and industries that have monopolistic power who are price gouging us. A lot of, a year and a half ago, I wrote an article during the boom of price inflation called The Anatomy of Inflation. And then I identify, well, the problems were mostly supply side, supply chains, both domestic and global, getting people back to work, warehouses, ports, and all those problems. Coming out of, when the economy was opening, coming out of the COVID recession, businesses that were monopolistic, were price gouging to make up for the revenue that they had lost. There were a number of these industries. A good example is the food processing industry, particularly baked goods. They were price gouging us, no doubt about it. And to some extent, they still are. Insurance companies are still price gouging us. Landlords, rents, still 2/3 of the CPI index for months now has been shelter rents. So a lot of price gouging was occurring. Now, as we've gone on, goods prices have come down because mostly energy prices, gasoline and energy prices have come down. That's the big thing that has reduced the inflation rate from what it was at a peak, 8 to 9% CPI, down to around 4% now. Okay, so, but services prices haven't come down. And that's what Powell was talking about in December 22. He said, well, look, we're making progress on goods. What we got to do is we got to get these services prices down. And that's what the Fed's going to be focusing on. Well, how does the Fed get service prices down? Well, it tries to engineer a recession. People lose their jobs. They don't have wage income. They cut back on their spending, and usually services, unnecessary services, are the first to cut down. Well, that hasn't happened very much. Just a little bit of the services inflation has come down. And if you look at the report today, we still have rent services, 2/3 of the CPI increase going on. So the Fed, at raising rates to 5.25%, has only had minimal success in bringing down service prices, and it's going to have to raise rates a lot more, which it isn't going to do in an election year. It's also not going to do it because rates, even at 5.25%, has produced a significant strain on the regional banking system and the commercial real estate sector. So they can't raise rates anymore, and they're not going to. But that means we're stuck with the services inflation. He's got to generate more unemployment if he wants services prices to come down in general as a group. Now, we may have a recession here. There's a lot of talk about recession, mild or not, occurring. I believe we have been in a goods recession. In other words, if you look at construction, building, and if you look at manufacturing, those have been contracting. That's the goods sector. Those have already been contracted. We are in a partial recession already. The goods sector is in a mild recession. The services sector is not. So you've got this anomaly that Powell is facing, right? He can't get services prices down without raising rates more, and he's not going to. Goods prices are coming down, mostly driven by energy and gasoline and fuel oil and so forth. And that's what the picture looks like for months now. It looks like we are stuck in this scenario where goods prices have pretty much flattened, and service prices have moved very little because we don't have as much unemployment as necessary to bring down consumption of services. And we're going to continue, I believe, moving sideways, crab-like, in the economy for the rest of this year. Will we have a recession? Well, nobody knows for sure. Will we have a recession in services? Nobody knows for sure. Will we have a chronic inflation, services inflation stuck at 4 to 5%? I believe so. And that's the scenario that we face. That's the trend. That's the trend that you were asking for. If you look into the job numbers, peel the onion, go deeper into the job numbers, you find a lot of the jobs that have been created are part-time temp jobs, gig jobs, and so forth.
Without benefits.
Yeah, they have weak benefits or no benefits, right? That creation, that reflects businesses unsure about the future, preferring to hire part-timers because they can get rid of them quicker, right? And temps, they can get rid of them. They can dump them if the recession comes. That's kind of where we're at. Now, Biden has been running around claiming that he created 14 million jobs, right? Well, that's not true, because when COVID hit in March and April of 2020, we lost a lot of jobs. The government shut down the economy, a good part of the economy. During 2020, at any given point, like 30 million people were unemployed at some point, maybe not for the whole year, but were unemployed. And, we lost 12 million jobs that simply shut down, right? We got those jobs back, those 12 million jobs back by the summer of 2021 when the economy reopened, in the spring and summer 2021. Those shut down jobs came back, those 12 million. Since then, we've created 2.7 million jobs. Okay. So Biden cannot claim that he created those 12 million jobs. Those jobs were there. They were temporarily shut down. And when the economy opened, people took it back. People came back. What's been created, truly new jobs since the reopening, is 2.7 million over 18, 24 months. That's not a lot of jobs created. And a lot of them are part-time and temp jobs. So, this job creation of 14 million is really a misrepresentation and a spinning of the numbers by Biden. He did not create 14 million jobs. At best, 2.7 million jobs over a couple of years, which is, maybe 100,000 a month.
How do you see this prolonged period of rather stable unemployment then, of people either not coming back into the employment sector, or only coming back as part-time employees or as contract workers or whatever? How does that square with the level of consumer debt that has increased and we get reports on constantly? And I look at the delinquency statistics on credit cards and automobile loans and home mortgage loans, and it seems to me that's sort of the strong signal out there that we have a serious correction coming, that all this debt, is that going to explode on us? And are we going to be able to deal with that if we go into a prolonged recessionary decline, let's say in 2026?
Well, if we have a significant recession, it's going to have significant impact. The problem is the debt, the household debt we're talking about now.
Yes.
Put the government debt aside. Put the Federal Reserve's debt aside. The government debt's like $35 trillion now, and the $8 trillion for the Federal Reserve. Put that aside, and what you got for household debt is $17.5 trillion. And it's run up pretty quickly here since COVID. Mortgage debt is the big part of that. Right, that's about $12 trillion. But you've got student debt, which is anywhere from $1.7 to $1.9 trillion, depending whether you include parent loans in it or not, right? You've got credit card debt that's over $1 trillion now. You got auto debt that's well over $1 trillion. So you add up all these major sources of debt, and you got to $17 trillion. Now, you got to realize, for example, credit card debt has really gone up, and that's where we're seeing the most delinquencies occurring, although yes, we see them in auto debt as well, right? Well, why is that? Why are people using so much credit cards, even though the rates on credit cards are well over 20% on average? And even though people are carrying, half of the households are carrying over debt month to month, which means they're paying 20% plus, unlike before.
Paying their minimum balances and not much more.
That's right. So, what that means, what that tells me is that wages aren't rising. Wage income is really chronically low. So people are using credit cards, and people are taking on other kinds of debt. Another indicator is they are taking loans out of their 401ks and using that as income. They're not refinancing their houses because the interest rates are so high. Another reason why they may be relying on credit cards more and 401ks more. But what that tells me is wage income has not been growing. Now, getting back to statistics, what you see is that this reporting of, wages increased 4.5%, faster than inflation, right? Well, that 4.5%, let's debunk that number now. That 4.5% is for full-time workers only, right? And it's an average, which means that, the 167 million people, including managers and supervisors and high-paid tech professionals at the top of that wage structure, are getting more than 4.5%. It's an average. So people at the middle and below are getting much less than 4.5%, but the government statistics don't break that out that way.
They might even be getting zero or negative,
That's right.
even in nominal terms.
That's right. At the very bottom, there's been a little bit, minimum wage has been a little bit rise in those couple dozen or so states, mostly blue states, that raise the minimum wage. But half of the country's states are still at that ridiculous 7.25 per hour federal minimum wage. And they haven't raised it, and they're not going to raise that federal minimum wage either. So, the bottom's got a little bit of a push on wage income. The very top got a big push on wage income. But what's happening in the middle? Well, if the bottom is rising and the top is rising, and we got 4.5%, the middle must be getting less than 4.5% to get that average. So the problem is using averages now, and not breaking that down. Another problem is that's the real wage, 4.5%, which means the nominal wage, what you actually got, is reduced by the inflation rate. But if the inflation rate is lowballed itself, that artificially boosts the real wage rate. You see? So, and that's another reason I think that the wages aren't as high as they say they are.
Do the statistics track the median wage levels against median inflation rate year to year, and then cumulative over a period of time? Because when we hear that the current inflation rate is 3.7%, that's on top of, since maybe 2015, what has been the accumulated inflation rate, and how is that compared with what's happened to the wages of most working people?
Yeah, well, when you look at real wages, you got to look at what is the price index that's used that adjusts nominal wages to, quote, real wages.
Yeah.
And when you get to that question, the problem is, what's the base year you are calculating your price increase from, right? Is it the year before? Is it 5 years before? Is it 40 years before? Whatever your base year is will have a big effect on what your inflation adjustment actually is. Now, this 4.5% that they give, there is a median earnings statistic, right? Median earnings. Earnings are your wages times the hours of work you've done, right? So earnings can be a reflection of working more hours, not a wage increase, right? Or it can be a wage increase, or both. There is a statistic that says, median workers, what's the median earnings, weekly earnings for workers, but it's only for full-time workers. You see, they don't have that for, your part-time and your temps and your 10 million independent contractors who are just workers. They're not really businesses. They don't break that out. If they did, that number would be much less. And there's like 45, 46 million of those people in the labor force. But we don't have a statistic that I'm aware of that factors in, because it's very hard to find out. You see, companies aren't asked to report, well, give us your wages for your part-times, and give us your wages for your temps, and give us your wages for your contractors. No, they're not even participating as much before, just sending a big aggregate number to the labor department. So they don't collect that because it's pretty hard to get that kind of a data. Now,
even if you tried to survey people by telephone, people who are part-time employed, how often are you going to be able to reach them to get the information from them on an individual level?
Well, you can do that with a sampling survey and population, and that's why the CPS, the population survey, I believe, is more accurate a picture, because it is a true sampling survey. The government calls 50, 60,000 people every month and asks them, are you working?
Yes.
Have you looked for work in the last 4 weeks? You know, if you're not, then you're in another category that's not in that 3.7%. But it asks them the questions, you know, how many hours you worked, are you part-time, and, you know, what your wage is, when did you look for work, you know, is it not 4 weeks, but less than 1 year? Is it you haven't looked in more than a year? Are you discouraged? Are you part of the missing labor force? And did you drop out? You know, that survey can pick that up. But that survey gives you a less optimistic look at the labor market. Okay, uh, and here's a statistic, though I think that's telling, and it comes from the Bureau of Labor Statistics, and it's based upon a base year for the index that goes back to 1983-84. Okay, that's the base year that's used. And when you look at adjusted for inflation over the long term, which is the real wage over the long term, not year to year, but, you know, based on when we came out of the Reagan recession, right, which is 83-84, you look at what is the weekly earnings of median worker adjusted for inflation. Well, back in 83-84, $365 a week was the real weekly earnings for a median worker. Right? If you look at where we were at the end of last year, $371 a week. So over 40 years, you've gained $6, right? Over 40 years at the median, okay? Adjusted for inflation, weekly earnings. I mean, that means that, you know, you've been stuck. You know, we rose a little bit, you know, in 2018, 19, but COVID knocked the hell out of it. You know, another problem is COVID showed, wages went up during COVID. Well, why did they go up? Because those industries that did not shut down, manufacturing and so forth, had higher wages, but those that did shut down had lower wages. So those who were left, you know, are higher wages. So the wage looks like it got bumped up. That's another typical problem you get in when you're manipulating statistics. But it's really, there's been no real wage earnings increase for the median working class person in this country in 40 years. Now compare that to the increase in capital incomes, you know, from financial assets and stocks and bonds and so forth, which is just increased, you know, accelerated.
Well, the couple of statistics that I found pretty consistent and telling about our economy. One regarding retirees. 1 out of 4 persons who's retired in the United States lives on Social Security benefits alone.
Mm-hmm.
And that doesn't buy you much in the way of housing or, you know, any kind of doesn't provide any real disposable income for much of anything. And I wonder, you know, how are those people going to get by if there's no consistent inflation adjustment in Social Security benefits? And
well, there is
this,
an adjustment that occurs every year in Social
just yeah.
And this is not the full inflation adjustment, but there is some. I believe the median or the average Social Security benefit is about $1,800 a month. I mean, how do you live on $1,800 a month? You know, one out of 4. Well, you know, you're on food stamps for sure. You probably got a little part-time job somewhere because you can work when you're on Social Security. In fact, the fastest growing sector of the labor force is people over 65 years old.
Yeah, that was the other fact that I was going to bring up, and I'm glad you did it. It's really, I wonder also how many of those individuals, those households, are looking to reverse mortgage loans in order to supplement their annual income.
They
and
do
giving
that.
up the equity in their property, which again, here we are in the United States. If you are fortunate enough to have owned a residential property, that provides the majority of your net worth as a household.
Yeah, or you use
Uh,
credit cards, they're one of the big users.
yeah.
Or what, 29% of kids are coming home to live with their parents, right? So maybe they help. In other words, people find ways to work around and survive, right?
Yes.
They aren't very pleasant ways often, but they're not living off of $1,800 a month because you can't unless you have a cheap rent in Tupelo, Mississippi, or something like that, right?
Is this a sign that the American dream is reaching a certain plateau, that the opportunity for your children to have a better life than you had is starting to become diminished?
Oh, I don't think it's a plateau. I think we're on the other side going down.
Down.
Okay. And if you survey millennials and Gen Zers, when 29% have to live at home with their parents, that tells you something
Yeah.
about the
Yeah.
affordability.
How about let's move on to the big picture in your last email you sent out. You talked a little bit about gross domestic product, and I've long felt that is probably the most leading statistic there is in terms of an indicator of economic health. That you know, what does it really tell us other than more dollars are being spent on more stuff, including things like cleaning up after natural disasters or expenditure on military, weapons and all that. How do you see the relevance of GDP, and how can it be adjusted to be a more meaningful, measure of economic growth or
Yeah,
health?
well, I've long been a critic of GDP. The problem is, what's the substitute for it? That's the problem. What else we got? There's a lot of problems with GDP. GDP is just the total amount of goods and services produced in the economy and sold in a given
Yes.
year, right?
Yeah.
But
Yeah.
GDP, as you pointed out, it doesn't matter what the content or whatever it is that is produced. You could boost GDP by increasing pollution, right? And then cleaning up the pollution. You could, boost it up that way. Um, there are other problems with GDP. For example, when you're trying to calculate what is the contribution of the housing sector, right? The housing sector to growth, which is an important sector of the economy. The good sector is like construction and housing, both commercial and residential, is like 8% of GDP, and manufacturing is about 12%. That's the good sector. The rest is all services, by the way. 80% of the economy is services, right? But when you look at GDP and housing, how do they estimate? The government? Now we're talking about the Commerce Department, not the Labor Department, right? How do they estimate the contribution of housing to the economy? Well, I think is ridiculous. You obviously would have prices on new homes rising, right? And production of new homes that would add to GDP, and apartments and so forth, right? But the government, the Commerce Department says also, what about rents, services, right? What about rents? And they say that, oh, the owners pay themselves a rent. Owners of homes pay themselves a rent. It's called equivalent rent. Go figure that.
Yeah,
Do you say
I've
every month, my mortgage is $1,800. I think I'm going to charge myself $1,000. So they actually make up that number. That's really absurd.
the argument, as I recall it, was if those individuals didn't reside in that property, they could lease it to a third party, a renter, and that would derive that income. And they're basically uh, receiving that income imputed, even though they're not receiving it actually.
Yeah, but that's an assumption. That's not the real world. They don't go out and they survey homeowners and say, how much you paying yourself this month, right?
Yeah,
They don't do that. That's an example of how you got these assumptions in these statistics, not just GDP, and you got a certain methodology. In this case, you got bureaucrats marking it up, right? That's all. Another example along those same lines is in 2013, they redefined GDP. And they boosted total output by about $500 billion then. What did they do? Well, they simply added new categories to GDP, like intellectual property, right? Logos, company logos, trademarks, right? Certain kinds of creative work. And they said, well, that boosts GDP by $500 billion. And by the way, they took R&D, which used to be an expense, and they said, oh, now R&D is an investment, right? And they added all that, and you got this new category in business investment called IP and software, right? If you look at the numbers for traditional business investment, plant and equipment, that's gone down. Structures, commercial property, that's gone down.
Actual capital goods investment.
Actual real investment that creates things, that hire people to create things. You know, when you say, oh, the value of my logo, company logo went up, right? Well, you didn't hire anybody for that, right? There's no jobs created for that, but they add it as business investment has gone up, right? Well, that was $500 billion, and it covered up the double dip recession that we had in 2015. And of course, it went retroactive and lowered all the recessions in the past. And it's been forward, and it's well over $500 billion now. And that boosts GDP, right? That boosts real GDP. It's questionable. I mean, the US isn't the only one to do it. In Europe, they added prostitution services to their GDP. You know, and I wonder how they come up with the price for that. I mean, does the government bureaucrat go down to the local bordello and interview the Johns when they walk out, and they say, well, how much did you pay? Would you pay more than last month? You know, and did the quality improve at all?
Well, as with cash businesses, they have some benchmark figures to show, for example, what is the average tips that a waiter or a waitress receives, or a driver of a taxi cab, et cetera, et cetera. So maybe they're able to extend that to the sex business.
Well, drug smuggling as well.
Yeah.
Smuggled drugs, they do the same thing to boost the GDP, you know, as if, you know, your smuggler is going to say, well, how much is this Coke worth? You know, the point is, the bureaucrats make up numbers. They make up numbers all the time, and they plug them in, and it makes it look like, you know, on top of it, there's a survey, but there's a lot of assumptions, a lot of definitions that are questionable. And the big problem with GDP numbers, what they report out is the real GDP adjusted for inflation, right? But the price index they use to adjust it for inflation is much lower than the CPI. There's another index called the GDP PCE deflator, right? And that's about 2/3 or 3/4 of what the CPI is. And the question there is, well, what's the methodology for estimating prices when you're talking about GDP, you know, price adjustments? Well, what's the methodology? Well, you know, there's like, what, 20, 30 million goods and services in the US, different kinds of things and different kinds of services. Do the Commerce Department, go out and survey people? No, they don't do any surveys. At least the Labor Department doesn't survey, right? Commerce Department doesn't do that. I mean, how can you survey 20 million different services? I mean, how could you come up with an appropriate, accurate sample for that? I don't know how. No, a lot of this is just extrapolating prices from other data. For example, when they say, how much have insurance prices risen? They don't go out to insurance companies and say, well, how much did you raise your price? No, they just look at insurance company profits, and they extrapolate from the profits the price inflation. Well, that's very risky, because, you know, profits are a function of three things, right? You either raise your prices, increase your output, reduce your costs. I'm sorry, that's the only way no matter what company you are, that's how you increase your profits, right? Well, how do you know that the profits weren't due to increased output or cost reduction, not price increases? You see, so it's very questionable the way they do some of these things, but average people don't know it. They think that, well, they actually know what insurance prices are. And by the way, in the CPI, auto insurance is going through the roof, as people know, right? And that's how they estimate auto insurance prices in CPI, which have been over 20%, right? Going on and continuing. It's one of the areas, along with the
20% on an annual basis?
yes, yes,
Oh my goodness.
yeah, year to
I
year.
mean, casualty insurance, I can understand with all the, tornadoes and earthquakes and, wildfires and floods. But I wonder what the justification is with regard to auto insurance
It
for
isn't.
such.
It's an area of price gouging.
Yeah.
It's an area of just price gouging. They're raising prices to make up for lost revenue, and they're doing it because they can. That's
Yeah. All right. Do you think there's a connection that the companies that also insure property, provide casualty insurance, are increasing in on automobiles to make up for the increased, uh, you know, uh, claims that they're paying off in other areas of their business model?
yeah, yeah. Of course, that's going on. In California, home insurance prices have also skyrocketed. Why? Well, because you have the weather situation in California, and also because you had all those fires in California in previous years, caused by
Yeah.
PG&E equipment, by the way, and they're making the homeowners pay for putting PG&E's electric lines under the ground now. That's what's going on.
It's almost overwhelming, Jack. I mean, and I'm someone that spends a lot of time looking at these statistics and trying to, interpret them and find what are they telling me? What are they forecasting in terms of the next, coming end of our current cycle? Are we going to have a deep recession? Is it going to be something worse? I mean, I have some colleagues, even a few economists that I talk to, that are thinking that 2026 is going to be worse than 2008.
Well, it may be 2025, maybe before six. But
So 2026, if the Fed and federal government do everything right, 2025 if they make mistakes.
yeah, well, one thing, as I've said before, about a recession, a severe recession is usually precipitated by a financial instability event, financial crash, right? And I think the Fed is, and some economists are really watching very closely what happens to commercial real estate,
Right.
particularly the office and the mall sector of that. Commercial real estate includes factories, which you have in growth now because they're trying to bring some tech and other manufacturing back to the U.S. But if you look at hotels and malls and office buildings, particularly office buildings, are in deep trouble. Over $1 trillion of debt has to be rolled over here in the next 18 months in that sector. If interest rates stay chronically high, and worse if they rise, then you're going to have more defaults in that particular sector, commercial real estate. Defaults in real estate, commercial real estate, impact the regional banks, which are already kind of shaky, at least a dozen of them still. In other words, they make most of the loans to local commercial real estate. So
Yeah.
if you've got defaults in commercial real estate office buildings, that will quickly spill over to the regional banks, and then you got contagion possibly. I think that's if it comes in 25 or 6, financial instability, that's going to be the locus of it. It's not going to be residential housing, but it could very well see commercial real estate play a similar role to what residential housing did in 2008-9.
Well, on the commercial side, the banks are usually taken out by a long-term mortgage granted by an insurance company or pension fund or something like that. So it sounds like the problem is if the buildings don't start to generate positive cash flow, there's no one to take out the construction loan from the bank. And now the bank has to deal with foreclosing and taking over this commercial property that may or may not be totally fully constructed.
Yeah, or in general, if you got a commercial real estate in an office building, owner or whatever, and they aren't generating the cash flow because people aren't in the building as much as before. They are in the red. Who's going to loan them money to keep? Who's going to roll over that debt to keep them going? If no one rolls it over, well, then it defaults, and those losses then are carried forward to the bank that loaned them. Now the bank has the losses and their balance sheet looks terrible, right? And that means their depositors start leaving. No one wants to leave their money in Silicon Valley Bank, right? When it's in the red, they move their money, the deposits move, and that makes it worse, right? And then everyone starts looking at, gee, well, maybe my bank is in the same trouble. Maybe it's not, but I'm going to take my money out anyway and put it in Fidelity just to be safe, right? So you get that contagion, whether it's justified or not, you get that contagion effect. And we could be seeing that in 25, 26. It depends on whether we have a significant real recession or not. A real recession will exacerbate all that.
Which brings up the question of whether or not the Federal Reserve has the tools to deal with the possibility of another recession. I mean, this balance of trying to keep interest rates high enough to keep inflation under control, but not so high to bring on the kind of recession that you're talking about. What if the recession happens anyway? Even let's say the Fed just keeps interest rates pretty much where they are today, and then we still go into a recession. There's no other tool. I mean, what are they going to do if they dramatically lower interest rates in order to deal with the recession? Then I think the same thing happens that happens back in 2010, is that the lower interest rates are going to be capitalized into higher asset prices.
Yeah, well, that's what I'm writing about in my new forthcoming book, which is called The Aftermath, the COVID recession and its consequences. One of the arguments I make there is that both fiscal and monetary policy are inefficient, increasingly inefficient, meaning that lowering interest rates, the Fed lowering interest rates to stimulate the economy takes a lot more lowering of the interest rate to get a corresponding bang for your stimulus buck, right? And conversely, raising interest rates, you got to raise it more to stop inflation, as we're seeing right now. Right? It's inefficient in stabilizing the economy, both on the growth end and on the inflation end. It's inefficient. It takes more of a cut in rates or more of a hike in rates in order to get an equivalent effect that you got maybe a couple of decades ago. One of the reasons for this, I believe, is that when the Fed lowers rates, for example, throws money into the economy, or does a QE and throws money directly into the banks and investors, a lot of that gets siphoned off into the financial markets. In other words, investors don't turn around and create factories that make things that hire people that generate wage incomes. No, they go and speculate in financial asset markets, not just in the US, but globally. Or they take the money, if they're a multinational company, you take the money and they expand their operations in Mexico or some other place. In other words, in both those cases, it doesn't boost the US economy. Monetary policy is becoming increasingly inefficient. To answer your question, if the Fed can't lower rates again to stimulate and throw money at the economy again, which is what it's been doing since 2008,
right,
consistently, Uh, when 2008 recession hit, the Fed's balance sheet, which is its debt, right, was about 800 billion dollars, right? What is it today? It's between 8 and 9 trillion. The Fed hasn't really stopped throwing money into the economy. And what we got after 2008-9 was a weak recovery historically. Only 2/3 of normal GDP growth following a recession occurred during that decade. Uh, and then the Fed tried raising rates a little bit, but Trump jumped on them and made them lower the rates again for reelection. And then we got COVID, and the Fed threw $5 trillion in March 2020, 2020, 2021, $5 trillion at the banks. And the banks didn't need a bailout. Unlike 2008-9, the banks weren't in trouble during COVID, but they threw the money at them anyway, thinking that, well, they might be in trouble, right? So now the Fed is desperately trying, with raising rates, trying to, and selling off its bonds called QT, quantitative tightening, trying to pull some of that money back out of the economy, but it's not having that much effect. I mean, the Fed balance sheet debt is like $8 trillion still. So long term, the Fed and central banks around the world are throwing money at the economy, and it's not having an effect because financialization of the economy and globalization of the economy. The money's just not getting into real investment. Now, you said, what are we going to do if the Fed lowers rates and we don't get a stimulus much in a recession because of the inefficiency that I talked about? What do we do? Well, you got fiscal policy. You could increase government spending and you could cut taxes. Now, the problem there is we got a set of contradictions parallel to the Fed central bank monetary contradiction. What are those? Well, the problem is since 2001, we've cut taxes $15 trillion in taxes. The related problem is we've thrown $8 trillion in wars in the Middle East and elsewhere. That was like down a rat hole, right? So you got $24 trillion just in tax cuts and in war spending, excess war spending. Then you got the bailouts, maybe $1 trillion, $2 trillion during Obama, the fiscal bailouts, right? And then in 2013, 2013, I think it was 2013 that Obama agreed to extend the Bush tax cuts of the previous decade in perpetuity, right? And that cost us $5 trillion. Then you got Trump cut taxes over $4 trillion, not the 1.5 they say. I can explain how. But you got 15 trillion in tax cuts, 8 trillion in more spending. You got the bailouts in 2008-9. You got about $4 trillion of fiscal bailouts during COVID. There's your 5 trillion debt. There it is.
And none of this that's been done, it seems to me, coming, from the perspective of, what I think is the correct policy to pursue based on my study of Henry George's work, for example, and from other economists who are sympathetic to that perspective, is that we fail in that we can reduce marginal tax rates, but unless we make a distinction between income that is earned by producing goods and service and income that is derived from rent-seeking privileges under the law, we're never going to get the right outcomes. And that seems to me that's exactly what we've been doing. Well, we've been doing it forever, but certainly that's what's happened since 2008. The argument that I think is not being presented by anyone in the media and by most mainstream economists is we need some kind of tax reform that no longer gives tax advantage to capital gains on financial assets and on the sale of land and natural resources. I mean, it seems to me that would go a long way to providing the right kind of stimulus for investment in real economic growth?
Well, you put your finger on it. Tax cuts that are earmarked and guaranteed only to be received if you actually do the investment in the U.S. Versus other kind of tax cuts, and there's no control over, once you give them a tax cut, where it's going to occur, if it's going to occur at all. They just may take the tax cut and hoard it, right? A good example is, you go back to JFK, right? They introduced what was called the investment tax credit, 7% business tax credit.
The so-called first supply side tax cut.
But you didn't get, a business didn't get that 7% unless you could prove you already did the investment, right? Mm-hmm. Then you got, the 7%, and it had to be investment in the U.S. Well, once you get to Reagan, it was, well, we're going to give you the 7%, regardless where you do the investment. If you're a multinational company, you can invest, in Singapore, and we'll give you the 7%, right? And we'll give it to you up front. You can take it up front. You don't have to, you could take 4 or 5 years, whatever it is, to actually do the investment. So it just became a handout, and you could multiply that across all kinds of provisions in the tax code, particularly for businesses and investors. There's all kind of freebies going on. That's why, that 15, 16 trillion of tax cuts since 2001, 80% of that goes to businesses and investors, not to households with child credit. I mean, that's a little sweetener that they throw in there in order to get the bill passed.
It is so difficult getting theory, tax theory on the agenda with our elected officials, because it seems they're trying to deal with the latest and greatest fire put out. And I don't know politically how we do that. It's interesting to me that right now, in this campaign that's going on, there doesn't seem to be any substantive discussion about economic policy.
Well, I think we're in the midst of what I call the great distraction.
Yeah.
Right. And what that is both parties have been and continue to be busy pushing issues to get voters to vote for them that are unrelated to the really important issues of, tax fairness, and does fiscal monetary policy stimulate the economy, and what's your real income? I mean, these real bread and butter issues that affect everybody, that used to be part of the public electoral debate, but which aren't now. I mean, what do we got? We have all these identity politics things. We got wokeism on one side. We got conspiracies and lies and all on the other side. And, we got these issues that are distracting us from the real issues. What I like to say is that, it's a great distraction. And in the meantime, both sides are picking our pockets, which they are.
Well, Jack, I really appreciate you taking the time to join me back here for this conversation. You've provided anyone who listens to this with Economics 101 for those who are seriously interested in understanding what's going on to us. And so I really thank you for this. And I continue to read everything you send to me. And I'm sure that sometime down in the near future, I'll be stimulated to invite you back for another discussion. But before we call it a day, why don't I give you the last word to give us some insight and advice, or whatever you think we need to know for sure about what's going on in the world today that we haven't covered, but is extremely important as a voter, as a everyday citizen. What is it that we really need to understand that we don't necessarily hear from mainstream media?
Well, it's what we started talking about at the beginning. I mean, don't take as biblical truth whatever the media tells you about the government statistics. It's not that they're lying, it's that they cherry pick.
Yes.
what makes them look good, that you need to get down below the surface to really understand what's going on. That's what I try to do. And on my blog, jackrasmus.com, by the way, I will be providing an analysis of today's inflation, CPI inflation numbers. Check it out in another day or so, where I'll dissect the reality of what's going on with inflation. We talked about it a little bit, and then I'll be talking about other topics. For example, we didn't have time to get into it, but why fiscal policy is facing similar contradictions that monetary policy is facing, uh, indicated by our national debt, 34 trillion, annual deficits of $1.5 to $2 trillion. And in other words, that tool is broken too, right? Monetary policy tool, fiscal policy tool is broken. So what are they going to do going forward is the big question.
Yeah, you tempt me to get into that conversation with you right now. Mark, the first thing that comes to mind is, are we going to be able to raise sufficient revenue to service that debt?
Well, that's the Fed. The Fed will sell more bonds. Okay?
Yeah.
But the Fed's going to have a problem selling more bonds because China and other countries are buying fewer bonds. So it's going to have to raise interest rates to attract domestic people to buy the bonds. And then if the dollar collapses here, which may happen in a couple of years, certainly fall in value as a result of the BRICS and an alternative global currency, that's a long run impact on the value of the dollar, which is going to make raising funds to finance the deficit even more difficult. So not just fiscal monetary policy, but external policy is breaking down as well. But we need to sum up, we need politicians who are talking about this, that aren't just interested in the great distraction. I'm not saying some of those issues are unimportant, but I'm telling you that the real issues for long-term welfare of our families are not being addressed.
Well, when can we expect your new book to hit the publishing house?
Not till the end of the year.
Not to the end of the year.
Yeah.
Well, it's hard to know what to expect in this economy by the end of 2024, but it'll be very interesting to see, since you say the end of the year, post election, what will be the policy changes that might occur depending upon which party remains as the majority in the Congress and in the presidency.
I don't think it'll make much difference which party. I think it's going to be the same next year. We're going to see what's called austerity and fiscal spending.
Okay.
Yeah, they're going to try to cut social programs, and because there's no end in sight to the increases in Pentagon spending and more spending, that continues to go through the roof. And they're not going to reverse the $4 trillion Trump tax cuts. Both sides like those tax cuts. So I don't see any resolution on the fiscal crisis, the fiscal policy crisis, except they're going to go after social programs and kick that can down the road again.
Well, with that, I'll thank you again for taking the time out, and I hope to talk to you again soon. I'll be following your insights as the months go by, and I look forward to the opportunity to read your new book and when it comes out.
Okay, my pleasure. Nice talking to you.
Same here. And so that's it for this edition of Smart Talk. For more information on this and other episodes, please visit our website, henrygeorgeschool.org. Again, I am Edward Dodson, and thanks for watching Smart Talk.